Let's now have a look at learning objective number one, which relates to describing inventory, how it is recorded, expensed, and reported. So basically what inventory is what businesses sell as part of their normal operations. So for example, if we look at Officeworks website, and you can see here that they're selling paper for printing, photocopying, etc. This is an inventory item for Officeworks. This is something they sell to customers as part of their normal business activities. Now, when a business acquires or an individual acquires paper, obviously for that business or that individual, this is a supply they might use to run the administrative aspect of that business. So this is no longer inventory for them. So what we're focusing on today is what retailers sell to their customers as part of their normal business operations. Right? So if we look at a store like Hobbyco, they sell model cars, radio control cars, model trains, etc. That is inventory for that particular business. So we're going to look at how to account for these inventory items in today's workshop. So inventory is a tangible resource, so a physical resource that is held for resale in the normal course of operation. So as I mentioned before, selling paper at Officeworks is part of their normal operations. So this inventory or these items are intended for resale. So again, that gets back to the part that this is a normal part of their business operations and a normal aspect of what they sell. So following the cost principle, we record inventory at its acquisition cost, and this includes all costs incurred to get the inventory delivered and or prepared for resale. So this is a very important thing. So we're not only interested in the costs of acquiring the inventory on a per unit basis, but we're also interested in the costs of bringing that inventory to a place of sale and a condition ready for sale. So let me give you a few examples as to what this specifically relates to. Now, in the 1980s, some business owners in Victoria, Australia, decided it would be a good idea to import this vehicle called the Lada Samara to Australia, which was a Russian-made car. Now, unfortunately, when they arrived, they had numerous quality problems, and they actually ended up rebuilding a lot of these cars for a condition that was ready for sale. So obviously they incurred not only the unit costs of acquiring this particular item, but also the costs of taking it apart and reassembling it so it is ready for sale. So obviously if we look back at our slides, we can see that the inventory cost includes all costs incurred to get the inventory prepared for sale. And putting back together these vehicles in a better condition and state, ready for sale, was part of this cost. Now, another cost is also delivering the inventory to a place of sale. Now, if we go back to our browser here and we look at the cost of shipping container movement. So for example, this is a website that I looked up earlier today, and you can see here it quotes me to ship a container from Houston, Texas to Melbourne, $1,651. Now, I'm not sure how legitimate this site is, but as you can see, that is a clear cost that needs to be accounted for when looking at the overall cost of inventory. So if we are importing items from the United States to Australia for resale, then we would need to incorporate the costs of this shipping as part of the overall inventory cost. So let me ask you a question now. CarMax purchased a vehicle for $5,000, paid $100 to transport it to the place of sale, a mechanic $450 to service the vehicle, a detailer $150 to clean the vehicle. Once sold, CarMax paid $200 commission to a salesperson. What is the inventory cost of the vehicle for CarMax? So please indicate which answer you believe is correct. So let's start with the cost of the vehicle. So the vehicle costs $5,000 to purchase. They pay $100 to ship the vehicle to the place of sale. So we add that to the inventory cost. They paid a mechanic $450 to service the vehicle, which is related to bringing the vehicle to a condition ready for sale. And they pay a detailer $150 to clean the vehicle, again, bringing the vehicle to a condition ready for sale. That gives us a total cost of $5,700. So the only item we have not included here is the $200 commission to the salesperson for selling the vehicle. Is this cost incurred as part of the overall acquisition cost and bring the inventory to a condition ready for sale? Well, the answer is, when accounting for inventory, no. You do not include the cost of commission, salaries, etc. as part of the inventory cost. That is an operating expense of the business, and therefore that is reported in the operating expense section of the income statement. So the correct answer in this case is 5,700, which is consistent with the definition of inventory cost that we looked at earlier. That is the cost of the item plus anything relevant to bring that item to a place of sale and a condition ready for sale, which in this case was completing a service on the vehicle and washing the vehicle. So if we look at CSL's balance sheet, you can see there that they have inventory costs reported as a current asset in their balance sheet. And this is the most significant, the highest current asset that they have, which for most retailers is an unsurprising discovery. So what we can see there is they hold substantial amounts of inventory for resale to their customers. So in the 2017 ended financial year, CSL holds $2.575 billion of inventory ready for resale. Now, this is obviously captured as a current asset because generally retailers expect to sell inventory items in less than a year. If they hold inventory items for longer periods than that, obviously that's a concern for a number of reasons. Inventory in stock a long period of time is problematic because it takes space away from having other inventory in stock. It obviously ties up the retailer's funds to that particular inventory, and that inventory may be damaged or decline in value over time because it becomes older and therefore less desirable. So for many retailers, what you will see is that if they cannot move inventory, they will discount it to get it out the door so they can create space and funds to acquire other, more popular inventory. So for example, when I go to Aldi, I frequently find tools like this. So spirit levels, all right, I've got plenty of them here. I've got squares, etc. that I bought from Aldi. People don't go to Aldi generally to buy tools for building or renovations, which is what I use these tools for. And so I'm usually able to get these tools quite cheap because Aldi puts them on special. So for example, I got 3 squares for $4. I got a set of 3 spirit levels for, I think it was $10. They were normally $15 because Aldi simply wants to move them through the door to create space for new inventory that hopefully for them will be more popular. Now for me, this is good because I get them cheap, I use them, etc. But for the retailer, obviously, they're probably not going to be so keen to stock items like this again in the future. Now, if we look at the different types of inventory systems, there are 2 main types of inventory systems. The first one that we look at today and we concentrate on for most of today's workshop is the perpetual inventory system. So this is the system where the cost of goods sold is updated each time inventory is sold. So that is perpetually. It continually updates that inventory record to reflect the cost of goods sold. And this is what you generally see in most businesses. So for example, if you go to your local supermarket, in this case we've got Coles, and you go through the checkout there, and every time the person at the checkout or you at the self-serve checkout scan something, they are automatically updating their inventory record and reflecting the cost of goods sold associated with the items that you are purchasing. That is a perpetual inventory system. So so a perpetual inventory costing system. So we always calculate what the cost of goods sold is every single time a transaction occurs. Now, some businesses use what's called a periodic inventory system, where they calculate the cost of goods sold at the end of the financial period. So that it is, they periodically calculate it at that time. Now, given most businesses use computing systems to track their inventory sales, they are able to quite efficiently use the perpetual system, and they have that constant record of what is happening with the cost of goods sold. So therefore, the number of businesses using the periodic system now is far lower than it might have been, say, 20 or 30 years ago. So you'll see in some ads for businesses, they refer to a term like stock take. So they have a stock take sale. And this term relates to the traditional stock take that many businesses would have conducted right at the end of their financial period. So they would have conducted a stock take in order to check what inventory they had on hand, then to determine what the cost of goods sold was for the period. Now, a lot of businesses still use this terminology in their advertising campaigns, encouraging you to go along and buy products so they don't have to count it as part of their stock take. But in reality, most businesses are still using the perpetual inventory system. So that's the inventory system that we concentrate for the purpose of today's workshop. We will also look at the periodic method later on in the last learning objective today, just so you're aware of some of the differences in terms of how to account for inventory when using that method. Okay, so let's have a look at a few examples of how we record inventory and the transactions associated with this. So here it says Devon Gifts purchases $20,000 of inventory on account on October 10 and records the purchase as the following. So they debit inventory and they credit accounts payable. Now, there's nothing really new here. We are acquiring a piece of inventory, so we debit that inventory increase, which is there in the first line, and we are obviously funding that through, in this case, borrowing and paying on credit. So we credit the accounts payable we are accumulating in this case. Moving on to the next entry, they have to pay, this business, a third-party carrier to transport the inventory to their warehouse. So remember, the cost of inventory not only relates to the unit cost of inventory we looked at here, but also the cost to bring it to a place of sale. So in this particular case, we debit the cost of the transport to the inventory account. So debit inventory for $300 and credit however we pay for this particular transaction. The next part we have here is on October 12, Devon is granted a $1,000 reduction in the cost of merchandise due to blemishes on the inventory. They record the reduction of inventory cost and payables as follows. So what happens here is they credit the cost of inventory. So the supplier has granted them a reduction in the inventory cost. So for example, yesterday I went to Beacon Lighting to return this, all right, which is a ceiling light that we are using as part of our renovations. And when the electrician was installing some of these for us, they found that one of these was bent on the base, and so I took it back and exchanged it for the one I just showed you. Now, Beacon Lighting was probably unlikely to send that item I returned back to the supplier. What is the supplier going to do with a light with a bent base? So they probably just credit Beacon some funds to cover for that particular item that is faulty. So Beacon then simply reduces the cost of their inventory by the amount that they have received that has been returned by the supplier accordingly. So in this particular case, what you can see there is the supplier grants them a reduction in the cost, and so therefore the retailer no longer owes the supplier the amount of that reduction, which is why we reduce accounts payable here by the $1,000. Now, what happens if a retailer receives a purchase discount? So let's say that Devon pays its remaining $19,000 bill to the vendor on October 15 and qualifies for a 1% early payment discount. So 1% of 19,000 is $190. So remember here, we report inventory at the cost value, which means cost value is equivalent to what we actually pay. So just like we reduced the value of inventory equivalent to the credit that was provided by the supplier, so we had a blemish or damaged piece of inventory, the supplier essentially gave us a refund. In this particular case, the supplier is cutting us a break and giving us a discount on the amount we need to pay. So accordingly, that also reduces the cost of inventory. So we need to reduce the cost of inventory by $190 in this case, and we pay the supplier the remaining amount we owe, which is $18,810, which completely settles the accounts payable that we had owing. Now, some of you might be going, well, why is this $19,000? Because the original amount purchased was $20,000. Well, remember, when we go back to the previous transaction, they got a $1,000 reduction from the supplier due to blemishes on the inventory. So in this particular case, that $1,000 is deducted from the original inventory acquired of $20,000, which leaves us with $19,000 from a cost perspective. So that is the amount we owe our supplier. So we apply the 1% discount to that $19,000, and therefore we record this particular journal entry. So if we look at a summary of what the overall cost of the inventory acquired based on the prior transactions we've just looked at, the original purchase cost was $20,000. We added $300 to that as a result of bringing that inventory to a place of sale. We deducted $1,000 based on the return received from the supplier due to inventory blemishes, and we also deduct the $190 associated with the purchase discount, which means the net purchase and the net cost of the inventory we have acquired in this case is $19,110. Now, if we look at the next particular transaction, what we're looking at here is two things, and I'll remove this text in a minute so it's clearer as to what we're looking at. But we're looking at money flow associated with an inventory sale and goods flow associated with that sale. Right, so the first particular entry here, so the first particular part of this transaction is associated with the sales revenue we're generating. And this is a familiar transaction because we've looked at the same type of thing with a service provider, except here we refer to it as sales revenue rather than service revenue. But we haven't looked at the goods flow element here because this is our first week where we're looking at how to account for inventory. So let's have a look more closely as to what is associated with these particular transactions, or this single transaction in this case. So on November 2, Devon sells inventory costing $400 for $600 cash. So what do we record? Well, the first thing is the money flow. We receive $600 cash from our customer. So we debit cash and we credit sales or sales revenue in this particular case for the $600. Remember, this is sales revenue. It is not service revenue. So we need to specifically have the account sales or sales revenue here that we are crediting. The second part is we need to look at the goods flow. So it says here we sell inventory that cost us $400. So in that particular case, we need to reduce our inventory holding by $400 by crediting the inventory account, and we need to transfer that somewhere because that amount has been used up, and we reflect that amount that's been used up in the cost of goods sold account. So the cost of goods sold account relates to the cost of selling inventory that is associated with the generation of sales revenue. So when we sell inventory items, that inventory that is leaving us, the value of that ends up in the cost of goods sold account. And so when we calculate our gross profit in a retailer, we have our sales revenue minus our total cost of goods sold equals our gross profit. And essentially what that shows you is the margin the business has in its sales. After deducting the cost of inventory from sales, what is left, and therefore what is left to cover operating expenses as well as provide for hopefully some form of net profit. So if we look at this in the case of CSL, what you can see here, if I expand this a little bit so we can see it more clearly, is they have all their sales revenue related items, and then they deduct the cost of sales, which is the same as cost of goods sold we just looked at, to give them their gross profit. So just under half of their revenue is taken away by the cost of sales or cost of goods sold. So in business, that's quite a reasonable margin. A lot of retailers work on the basis of a 30% margin in terms of their gross profit compared to their sales revenue. But obviously, this depends on the nature of the industry. It depends on the other operating expenses the business needs to cover. It depends on the competitive state of the market. So if it's a really competitive, high turnover market, you might find that the gross profit proportion is a lot lower in those particular instances. So if we minimize this again. So in terms of where we report inventory information. So in the balance sheet, the inventory is expected to be sold within a year. So remember I said earlier today that this is captured as part of the current assets section of the balance sheet. The income statement reflects the value of the inventory that we have sold within the cost of goods sold line. Okay, so when we acquire the inventory and hold the inventory, it's in the balance sheet, current assets section generally. When we sell it, it ends up as a cost of goods sold in the income statement.